In recent years, people have said, hang on a second, owners don't necessarily want to think solely about their companies maximizing profits, but there are other environmental, social, and other concerns that they wish to take on board. That is quite right if the shareholders are also the beneficial owners.
Welcome back to Breakout with Breaking Views, brought to you by PGIM. I'm Peter Fellas, the acting global editor of Breaking Views, coming to you from Canary Wharf, and today I'm talking again to Edward Chancellor. Eddie, good to see you again. This week we're talking about shareholder democracy. It's often expressed in simple terms as the idea that a company should be accountable to its owners, but as often in finance, things are a little bit more complicated than that. Eddie, tell us how you look at this issue.
Well, the question of how public companies, listed companies, are held accountable to shareholders has gone on for 300 years. Adam Smith looked at the issue and said it was just impossible to run such companies because the owners wouldn't care for the company. Negligence and profusion would necessarily result. Now, we seem to have got over that problem, and the one of the ways of getting over that problem was expressed by Milton Friedman, the economist, back in 1970, where he said that the social responsibility of a company was to deliver profits for its owners, and that the company managers were really the employees of the owners and had to take their considerations into account. And if they would do anything other than maximize profits, they would be liable to hurt their owners. Now, that was a view that sort of, let's say, has held sway for much of the last 50 years. But in recent years, people have said, hang on a second, owners don't necessarily want to think solely about their companies maximizing profits, but there are other environmental, social, and other concerns that they wish to take on board. And the thrust of my piece is saying that is quite right if the shareholders are also the beneficial owners.
So that's the issue, right? It's sort of this ESG trend, and it's obviously a massive trend in financial markets, and seems to appeal to people as an idea that you would sort of invest in things that are responsible in terms of the planet and their employees and so forth. But I guess one of the questions that you seem to be tackling in this piece is do the investment managers, are they actually properly representing the ultimate investors, the people who give them the money?
Well, there's the rub. I mean, if you invest in a direct ESG fund, which has a clear remit to vote your shares on ESG guidelines, I think that's pretty straightforward. The trouble is that many fund managers who are running funds that don't have specific social governance and environmental mandates have taken on board a lot of these measures. Now, Natixis, the French bank, did a survey last year, and they said that 70% of fund managers said that they were adopting some form of social criteria. Now, the problem there is that, as Friedman pointed out 50 years ago, is that social responsibility is a pretty fuzzy issue, ill-defined. And if you look at it, there are lots of potential conflicts. Now, take, for instance, an energy company. The environmentalists might say, yes, this energy company should divest from fossil fuels in order to reduce global warming. But the company also, there are other stakeholders, namely the customers of the company, who might think that they don't want their heating or their gasoline bills to go through the roof. So, think about companies, about employees. Does a company maintain high-paid jobs at home for its employee stakeholders, or does it sack those employees and take those jobs to cheaper locations abroad? These are very complicated issues, and they're in effect essentially political issues. And the problem is that it's not clear that all shareholders are being represented in these views.
So is there a way to solve this problem, sort of with technology or whatever? Can you sort of devolve some of these decisions to the people who ultimately are the owners of the company?
Yeah, I think there are ways. I mean, what I would add first is that the what the problem is exacerbated by the growing concentration of the investment industry, especially around the providers of index funds and ETFs like BlackRock and Vanguard and State Street, who now manage tens of trillions of dollars. And about 4 years ago, the Larry Fink, the CEO of BlackRock, sort of started pushing this social agenda. And as one billionaire American property mogul, Sam Zell, said, he didn't know that Larry Fink had become God. And more recently, Charlie Munger, the vice chairman of Berkshire Hathaway, Warren Buffett's vehicle, said that he worried about these new emperors that had arisen, who had this immense power. Now, Merrin Somerset Webb, who's an English journalist, financial journalist who we know, has written a book called Share Power. And her argument in this book is that the technology now exists to return voting power to the beneficial owners. So if you own shares in one of these large institutional investors, whether in a pension fund or through a savings vehicle, a mutual fund or whatever, there is a technology, there's a company called Tumalo, that actually allows the institutional investors to pass through to their underlying investors, to the beneficial owners, connect them with the companies. And at that point, those companies those investors can say, well, actually, I want to vote on these board resolutions. I want them. And she cites a case where there's a provider of down jackets that the shareholders actually wanted the company to stop using feather down in their jackets, but the company was refusing. So these are issues in which you can effectively allow an ESG criteria to be realized, but at the same time maintaining shareholder democracy and not allowing the fund managers to stick their own preferences in the way.
I guess ultimately, it comes down to whether or not people actually can be bothered to vote on these things. But I mean, that's always the question here. But also just thinking a little bit about returns. What's the evidence that actually that this is there any evidence that this is better for investors in the long run, or do you have to accept that if you're running the company to care about the planet or the employees, that as an investor you also have to accept you're going to make a lower return?
Well, it's often said by the people who are proposing to put an ESG overlay onto their portfolios, that in the long run, what is good for the planet or what is good for society is good for shareholders. And that's not entirely untrue. I mean, Milton Friedman would have said, if you pursue profit, you have to take into account your employees and all the other stakeholders in order to keep them happy, in order to generate profit. But the trouble is that if you limit your investment universe as an investor, or if a company accrues extra costs or limits its activities, you're bound prima facie to have lower returns. And Somerset Webb in her book cites a piece of research, admittedly quite old, 2008, that pointed out that so-called sin stocks, that companies, tobacco and arms makers and so on and so forth, had outperformed the markets of 21 different countries over a 25-year period. So yes, I think there is an investment trade-off, but I think it will also bear in mind what Friedman says is that the point of the companies and the management of the companies should reflect the investors' views. Now, if the investors wish to make that trade-off, then I think it's quite up to them to make it. What it's not up to is for the fund managers who don't have a specific mandate to start making those trade-offs on behalf of investors who don't necessarily agree with their views.
So shareholder democracy, maybe it's actually going to happen this time. Eddie, it's always very, very good to hear from you. And thanks very much.